Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm always here to help you maximize your cash flow. Today, we're going to be talking about the beauty and simplicity of indexed universal life insurance, also known as the IUL. I know what you're thinking. Simplicity? People are always talking about how complicated IULs are, especially in relation to other things that you could be doing with your money, putting it in a savings account, buying whole life insurance. Just drop it in an index fund and invest it in the stock market. Why get into the complications of mixing life insurance and potential growth on indexes in the market? It gets all complicated. Well, I'm glad you asked that. To me, it's like a Toyota Camry. Toyota Camrys are known for their reliability. It's a great car. And if you own one, you just don't really worry about it. You change the oil and you drive it and you put gas in it. And that's basically all you do when you own a Toyota. Very simple, right? But if I wanted to convince you not to buy a Toyota Camry, I might say, look at the engine in this thing. Look how complicated that is. You don't know how to work on that. You don't know what this does or how to replace this or what happens if something in here starts making a noise. You don't know what you're going to be able to do. It's so complicated, you shouldn't get it. Just stick with, I don't know, cars from 50 years ago that are much simpler. The problem is cars from 50 years ago required quite a bit of maintenance, way more maintenance, a lot more oil changes, a lot more checking of the fluids, way more maintenance than your newer cars of today that don't require very much. Things are made with tighter tolerances. And while it may be complicated under the hood, the simplicity of owning that car is that you don't really have to worry about it because all that complexity is taken care of by the experts. And if you need to get work done, you just go to the mechanic. You take it to the dealer, you take it to your own mechanic. Somebody knows how to work on that. And you rely on them to do the things, the complicated things that need to be done to make sure that your car continues to be simple for you to own. The IUL can be very similar. This is one of my IUL policies you're looking at right now. I bought it back here in 2018, right near the end of it. And since inception, I've been earning about 7.48% average each year. Total interest earned over that time, $9,380. My accumulated value, $46,000. Let's go down here and take a look at total premiums paid, $42,000 over that time period. My annual payment, I pay $6,070 a year. That's what I've been putting into this. And I've made nearly $10,000 so far on that money that I've put in. And what have I done with this thing? Practically nothing other than make my premium payment. Now, for you astute observers that take a look at everything on the screen here, you'll notice the surrender value is very, very low. So maybe not such a good product because I don't really have access to very much cash. But wait, I wouldn't do you like that. The reason is because I have loans outstanding on this. Remember, I've paid in $42,000 into this policy, and my loan balance is $43,000. I've borrowed out more than I've paid into it. And my interest rate that I pay to borrow, 4.6%. Remember, I'm earning 7.48 over that time period. And I borrow extensively from this, and my current rate is 4.6. Now, this rate can adjust, and a lot of IULs will have a rate right at 5%, or it might max out at 5%. I think in this one, it can go up to 6, but it hasn't, at least up until this point. But the point of this isn't that I'm earning arbitrage. The point of this is it's been very simple for me to own this thing. Put my money in, it grows based on the S&P 500 up to a certain cap, and I basically don't have to do anything with it. All the complicated stuff happens on the back end. Now, I don't want you to just think you can go out and buy any IUL and you're going to get something similar to this. This was a well-designed policy that was designed to match and optimize for the amount of funding that I'm putting into it. That means the expenses are minimized so that they don't take up very much of the overall amount of cash that I have in the policy. Now remember, I paid in $42,000. So if I have $46,000 in accumulated value, almost $47,000, that means if I've earned $9,000 in interest, That's almost $4,000 that's gone out in expenses over the last 6 years. We're almost to year 7. We're almost to year 7. Now, that's not so bad inside of this policy. Your typical IUL, normal design that you go get from any life insurance agent off the street, or your brother-in-law that was recruited into a multi-level marketing organization selling insurance and he wants to recruit you. Okay, this is the kind of design that they're going to sell you. And in the beginning, it's going to be a really high expense ratio, upwards of 25% in that first year. Over time, if you own it for a long period of time, it does get to a very low average. Generally, that expense ratio could get down into the 0.1, 0.2% range. And because you had really high expenses up front, your overall long-term average might actually be 1 to 2%. Okay? That's actually fairly high. I would not advocate for this type of a policy. The type of policies that I design look more like this. We're going to start somewhere down here in the 10% range, and it's going to go down. Oh, I went too low. It doesn't go below 0, but essentially, the expenses get down very quickly. Let me see if I can do a better job on this. We're going to start somewhere in this range, and if you max fund these designs, like, it is going to go down drastically, very quickly. And then it just goes and it continues along. And basically, our long-term average is going to be maybe less than 0.5%, even when you account for the higher expenses out of the gate. So that's the kind of policy that I'm advocating for, not this kind, where we start off with massive expenses. Most agents, the challenge with selling these policies is getting people to ignore this high early expenses and lack of liquidity and look out down the road at how well your policy is going to be here. Look at the low expenses and the high cash value. Well, if we just cut those expenses right at the beginning, we don't have to worry about that. This is where the beauty comes in. We still get the advantage of owning this product that's going to carry a very, very low expense ratio decades down the road. And we don't have to deal with all the really high expenses up front. Now, how these work, the IUL, how does it grow? In this case, we're going to take the S&P 500. That's this dotted line here. The S&P 500 goes up and down throughout the years. Okay. And great investment. I'm not advocating that you avoid it. We like a little bit of diversification that provides us some downside protection. And that's what happens inside this product is I'm going to allocate some of my money to fund the IUL. And the way that it starts out is we put our money in. It's going to grow based on the index, but only when the index is up. So in this case, S&P starts off. This is my annual point to point. The S&P goes down. My value just stays even. S&P goes up. I'm still here because I don't find out what my credit is until the end of the year. S&P is back down and then it's back up. And at the end of the year, it's up a little bit and I get credit. The value in my account will go up. Now there's going to be some expenses. So that's why it's important to minimize the expenses. But the actual cash value in here is only going to go up based on market returns. You see here again, the market is down and then up and then down and then up, and we get another credit. Then following year, the market's down and then up, and then it went way down. And it finished well below where it started at the beginning of that year for me. I just don't get any credits that year. But my annual point to point gets reset way down here. I don't have to wait for the market to recover to get another credit. Market's down, it's up, it's down, and then it's up higher than where we started that year. And so I get another credit. So even though if you were actually in the market right here, you're only barely up here and you're down from where it was the year before. But in the IUL, we're up. We only stair step up. It doesn't go down based on market returns. It will go down if we don't get any credit from the market returns, because we could get a 0 credit in this scenario, but it's only going to go negative by whatever the expenses are in paying for the policy. So we want to make sure that our expenses are very low in an ideal designed IUL. So when I talk about the beauty and simplicity of the IUL, we are talking about a well-designed IUL with low expenses. That's the key, low expenses, so that we can take advantage of when the market goes up and when the market's down, we don't lose any of our money. Now, remember, we're looking decades out, and we expect that expense ratio to be 0.1, 0.2% value in the policy. So if our value is way up here and we get a 0 year, it's only going to go down a tiny fraction based on the expenses and not having a credit associated with it? Well, there are some policies that will always give us a credit. Instead of 0 being the floor, we might have a bonus that's always 1% or always 0.9 or always 0.35. There are products out there that give us a bonus that's guaranteed that will definitely exceed the cost of the insurance later on down the line when we've reduced that cost to a minimum. In the beginning, it might take a few years, but after just a few short years, we expect that expense ratio to be getting close to 1% of the value in the policy. It should get there very quickly if we're max funding a properly designed policy. Let's go back to my policy. This is from my most recent annual statement. You can see the value before I made that next payment. The value is at $38,688. My expenses, $762.16. My cost of insurance, $121.20. That gives us a total expense of $883. That's an expense ratio of 2.2%. And I'm 6 years into this policy. We're getting very close to that 1% expense ratio. And meanwhile, this whole time, my cash is downside protected from the effects of the stock market. But it does go up if the S&P is up. Now this year, my expenses are going to be almost the same, except we saw my cash value was already at $46,000. Let's say my expenses go up to $900 from $883. So they may go up a little bit. I still have some growth opportunity left because I could get some credits over the next couple of months. Our expense ratio is going to be closer to 1.9%. And it's going to keep going down year after year after year. Now, when I hit year 10, this charge right here goes away. Correction. It doesn't go away, but it gets very, very small. This charge is where they're recouping the expenses that it took to sell me the policy, paying commissions, paying for underwriting, ordering any medical exam or medical records, all of those things. And they recoup that over 10 years in this particular product. Well, they also have a small accumulated value charge as well. In this case, it's a 0.35% that goes for 25 years. So this doesn't go to 0, but it's going to drop way, way down. So if my account value is $100,000 at year 10, the expenses to sell me the policy go away, and I'll still have $350 in that accumulated value charge. So if I have a $100,000 account, $350 for the contract expense, and my cost of insurance, let's say it doubles from here. It's going to be another 5 years. So now we're at $240. I have $100,000 and my expenses are about $500. That means I'm going to be at a 0.5 expense ratio in year 10. Now I should actually have more than $100,000 by then. If I continue to put in $6,000 a year and we continue to get growth, I'll probably be a little higher than that. Oh, wait a minute. I was thinking 10 years from now. In year 10, that's only a few years from now. Because right now I'm at the end of year 7. So that's only 3 more years. So correction, I'm not going to be at 100,000. It'll probably be more like 70,000 that we have in there. So that's more like a 0.7% expense ratio. But it's clearly marching downward. We're going to be getting to that point where it's a very, very low expense ratio. And meanwhile, I'm still going to be kicking in $6,000 a year. Now, the true beauty in these products is when I get to retirement. When I minimize the expenses to optimize for cash growth, I'm going to have a 0.1 or 0.2% expense ratio each year in retirement. Well, as you get older, it gets harder and harder to do the finances yourself. It gets harder for you to manage your own portfolio. So anything that's not inside of a product like this that has downside protection and guaranteed growth or potential growth, you're probably going to have to pay somebody else to manage that money. Me personally, I think that it's going to be amazing when we get to this point and the insurance company is still managing this money for a low expense and giving me downside protection, which you can't get if you're just invested in the market or you're just with some type of financial advisor that's investing in the market. They're not going to give you any downside protection, but I can still get good gains when the market's up. So this kind of gives me the best of both worlds here. Now, how they do that inside of the IUL, how the engine actually works, a lot of you don't even care. You're just saying, I want to be a part of that. I would like to have something like that. And if that's you, schedule a meeting with me and let's talk. Let's see where this might fit in with the rest of your portfolio to hopefully help make it safer and we can get you some life insurance protection to go along with it at a very affordable cost. If you're interested in how it works under the hood, I'm going to be coming out with another video, so watch for that, with how the annual point-to-points work inside of the IUL to grow money and how you could actually do it yourself, because you could actually do it yourself. You can trade just like they do in here, but it's not easy. It's complicated. You're not going to have access to all the same type of things that they have access to, and I'm going to go over that in that video. But if you're interested in the details of this, that's what I like to get into as well. So stay tuned. Be sure to hit that like button and subscribe so that when I do drop that video, you'll get to see it. In the meantime, you can check out my IUL series. I did a 4-part series diving into almost everything you need to know about the IUL. It's the most popular series on my channel, and that's going to be linked right up there. As always, leave any questions or comments down below. I'm happy to help you out. Thanks for joining me, and we'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.